Welcome back. Today we're talking about Covenant Logistics Group. They are a trucking/logistics company and they're a small cap stock. So y'all know my favorite type of stocks are small cap stocks because they're usually more volatile and they're more inefficient markets. You're more likely to see big price discrepancies on small cap stocks versus the giant stocks, right? And as far as trucking stocks go, I think y'all know how I felt about USA Truck. They were my biggest and my favorite position before they were bought out. So naturally, I've been watching this sector since then. My favorite one before Covenant was actually ARC Best. But the problem there is, look what it's done year to date. Like, I still really like this stock, but it's up almost 50% year to date. So I think I sat and waited too long. I got greedy. I was hoping to get it in the 60s and I just never did. It got down to 70 and 70. And I always thought like once it gets in the 60s, I was going to buy it. And that was a lesson in being stupid. Okay. So anyway, let's go back to Covenant because they have not run up year to date. If anything, year to date, they've had a drop off. So net year to date, they're only down 5%. But what really got me interested in them was whenever they reported their fourth quarter earnings, the stock dropped 22% that day. Okay. Now, since then, it's run up it ran up 18% and it's traced back down a little bit. But anyway, right now it's $33 a share. So what we're going to do, we're going to look at the financials. Then I'm going to do a valuation to see what I think fair value is and then come up with with my buy price. Okay. So let's get started. The first thing that's really got me intrigued about this stock is this article here. Covenant Logistics Group announces amended stock repurchase program, okay? So what's neat about this, and I'm going to summarize, they added $37.5 million to their existing plan that was only $17 million. So now they have an outstanding plan of like $55 million that they can buy back shares, okay? So on a market cap of $440 million, $55 million is a crazy amount, right? That's awesome. If a company's filing to buy more shares, that's usually a pretty good sign for the outlook, right? Okay, and then I just want to go over a little bit about the company. So I'm going to pull up their investor relations page. So here's their investor relations page. And what's neat, if you scroll down, and I'm going to link this, of course, you go to this earnings info tab, and you sort by the year, and then for each quarter they have their script that they read before the the earnings call. They have their press release where they announce the financial results, and then statistics. And statistics is just going to be their key operating metrics. They have their fleet information, their balance sheet, cash flow information, and then down here, this is just what I wanted to show you. They really operate in three different segments, right? And I'm going to look by operating income, which one generates the most amount of operating income. Of their $22 million of operating income in the quarter, 10 came from the expedited section. That's one of the three sections. That's actually truck driving where it's like a two-person team so that they can minimize stops and get somewhere as fast as possible. Then they have a dedicated section that's what you think of as just general trucking, and then managed freight, which is really that low asset logistics side of the business as well. With that out the way, let's move to the financial statements. First thing I'm going to look at is the total revenue, and this is every quarter going back to 2007. Okay, so over 16 years of data, okay, in every quarterly report. And revenue's really been growing recently, so that's a great sign. But we really don't get any valuation metrics from revenue. I think anything that uses price to sales or anything like price to sales is kind of silly. So instead, what I'm going to look at is the operating income, okay? And operating income for trucking companies is super important because what they all really judge themselves on is this thing called operating ratio. And you might have seen it on those bar graphs that we looked at in their statistics section. But operating ratio, you can think of it as just like a reverse of operating margin. So in this case, over 100% means that they're losing money. And then so like the lower, the better. So trucking companies are always trying to get a lower OR, is what they call it. The most recent quarter was 97. So that's a little concerning, just a higher OR. Look at this spelling, my bad. Anyway, so that's operating ratio. Let me go back to operating income because I want to show you something. Let's see, where is it? Operating income. Okay, so switch this back to dollars. Operating income, you can see that like they're averaging, let's just say $10 million a quarter, okay? But then what's interesting is that if I look at their pre-tax income, so this is after other expenses have been deducted, their pre-tax income is actually way higher. It's up here in the $20 million a quarter range recently. All right, so what's going on, right? Usually if you see a big discrepancy between operating income and pre-tax income, you need to drill down into other income. So if I pull up other income, what you're going to see is that they're actually making a lot of money from this investment they have in another company. And they talk about it a little bit on the investor relations page. You can read about it. I'm not going to waste time. Let me just remove these outliers to get the scaling better. Yeah, so look at this, like $5 million a quarter and growing from that equity investment. So that's good. I mean, no, that's not good. That's great. But I don't want to count for that whenever I'm doing valuation. So what I'm going to do instead is really I'm not going to focus that much on the income statement here, okay? I'm more concerned with cash, and you're going to see that once we get to the cash flow statement. But usually whenever the income statement has confusing things in it, like I just defer to the cash flow statement because, cash is king, right? If cash is going in or if cash is going out, like that tells you way more than like what income's doing on paper, right? So you'll see whenever we get to the cash flow statement though. But next I want to go over the balance sheet. Okay, and the first thing I pull up is tangible book value per share. And y'all know I don't care what this price to tangible book value is. Like I don't care that it's $30 and selling for 20. What I care about is that it's growing unless they're paying dividends, right? If they're paying a lot of dividends, I don't mind if this is flat. But like if a company is making money, and they're not paying dividends, their tangible book value per share, like by definition, has to grow, right? Because the money's either being used to pay down debt or buy back shares or buy more assets. So either way, it's going to raise that tangible book value per share, unless they're buying intangible assets, which, sometimes you need to account for that. But, in this case, most of their assets are tangible assets. All right, so this is great. I really like seeing this. I like seeing especially that we're not losing that much money in the down years, okay? Because the trucking industry is super cyclical, super competitive. You're going to have years where you're not making money at all, where the company's not making money at all. Okay, so seeing that, the equity's not taking a big hit during those downturns is good. All right, and then next, we're going to just take a quick look at their debt to equity ratio. So this is just all the liabilities divided by all the equity. And you can see we really started making some progress. It's like they started in 2016, 2017, and then we had that period in the trucking industry where it was really bad for a while, and then COVID hit and kind of hit the reset button and all that. And trucking companies have been doing really good since COVID. So they were opportunistic and either raised equity or lowered debt. Okay, so we'll just look. I mean, we saw the equity was going up. I just want to look at total debt real quick to see that as well. And yeah, look at this drop off in total debt that happened in 2020. So that's a good sign. I mean, I love companies that hate debt. Now let's go to the cash flow statement because this is going to be the most important piece. Okay, so the first thing I want to talk about with the cash flow statement is that I don't have the data yet for Q4 2022. I think that you could back calculate it from some of the stuff they've provided, but Yahoo Finance doesn't have it yet because they haven't released their 10K yet, so you're not seeing the Q4 numbers in here whenever you're looking at the quarterly numbers, okay? So start with operating cash flow. I mean, this has to be positive, right? If you're investing in a business that has a negative operating cash flow over some period of time, it's okay if it's bouncing as long as it's positive and growing, and this one is. So this is a great sign. Like seeing this, okay? The next thing to always look at is free cash flow. So free cash flow is going to be operating cash flow minus capital expenditures. And what you're looking for here is making sure that the company is not having to invest a ton of money in CapEx just to stay floating and that they're not generating free cash flow. And you'll see here that the Yahoo Finance's definition of free cash flow is like around zero. I mean, I don't need to average it out, but if that, it could be negative. But this is a case where you got to be careful trusting these data centers that just group all the I don't know what you call it, financial information together, because what's actually going on. So if I pull up capital expenditures, you can see that it's somewhere along the lines of $20 to $40 million a quarter. But what's happening is that it's only calculating the property, plant, and equipment purchase, whereas what goes on in these companies like the trucking companies that they're constantly turning over old equipment and buying new. So there's going to be some net capex. They're going to be selling some and buying some. So if I look at the purchase of PPE, it's the same graph as the capex. But whenever I combined the sale and the purchase to see what their net PPE is, you can see it's actually not that bad. It's only slightly negative because every quarter they're selling some back and buying. So got to be careful not to just take the book definition of free cash flow. I think this is a good example of when sometimes you have to make your own metrics to get to a better cash flow. So what I did is I made an adjusted free cash flow, which is operating cash flow minus your net capex, not just the capital expenditures, but also the proceeds. So this is great. What I want to do though is I want to put it on a trailing 12 months basis. So this just smooths out that curve. And then, even better than that, on a per share basis too. So adjusted free cash flow, trailing 12 month per share. Okay. And this is where you can really see the cyclicality of the trucking industry. But the good news is it's growing, right? So cyclicality is not bad, but you just got to know how to price it. You got to price it conservative, and you got to make sure that the company doesn't have so much debt that whenever it's losing money here, it runs the risk of defaulting or something like that. So that's the big concern. But I think we saw in the balance sheet that that's not a concern. And now we're going to go into how to value this, okay? So there's a few ways to value this. We'll go over the hard way first, which is to try to predict what you think the cash flows are going to be for the next few years. And just me reading the sheep guts, if you will. Let's just say that they go down to zero again, not negative because they shed a bunch of that debt, and then come back up to $8 a share by 2025, 2026, okay? So this valuation, you would say, okay, year one, they make 4, then they're down to 0, and year 2, year 3, they're back to 4, year 4, they're at 8, and then growing at some small perpetual growth rate, like 3 or 4%. So let's see what that looks like on the DCF model. Okay, so what did I say? In year 1, they're making $4 a share, then down to 0, then year 3 back to 4, and then year 4 up to $8 a share, and then growing at, let's say, 3%, and at a discount rate, I like to use 15%, so I'm going to use 15%. And you can see the terminal value here is $50 a share, okay? Meaning that's the net present value of this cash flow stream, okay? If it starts at 4, dips to 0, comes back to 4, then grows from 8 at a small growth rate, about $50 a share is what it's worth today, okay? So that's the complicated way to do the valuation. I'm gonna go over an easier way. Let me pull up the trend again. Okay, so the easier way, which is probably going to give us the same number. It's just to kind of ballpark and say, man, they're making, let's say, $4 a share, and they're going to grow at, whatever they've been growing at. So let's say from 2012 to 2022, they went from a little over 4 to a little under 8. So I want to get a compounded growth rate from that. So I do 8 divided by 4, and then I'm going to raise that to the 110, which I know that's going to be 7%, right? Because if it doubles in 10 years, it's 7%, but that's a 7% compounded annual growth rate. So let's knock a percentage off of that and say 6% just to be a little bit safer. And then I'm going to go back to the DCF model. Okay, so in this example, I'm just going to put a 4 here and then discount at 15% like I always do, and then perpetual growth at 6%. And you can see our terminal value, $44, pretty close, okay? $50 a share. Let's just split the difference and say 47. Okay, so $47 a share is what fair value is probably close to. To get that to a buy price, I'd like to multiply by anywhere from 0.5 to 0.67. So if it was 0.67, I'd say our buy price is $31.50. If it was 0.5, then we're looking at, what is that? Oh, not 0.6, 0.5. We're looking about $23 a share, $24 a share. So for me, then the buy range is definitely, in my case, anything under 24, and probably if it gets under 31, I'll probably be greedy and wait for the 20s, and then it won't get there and it'll run up 50% like ArcBest did. But anyway, that's really it for the valuation. I did want to show you before I left one red flag, and that is the insider sales. Okay, so let me pull that up. Okay, so now I'm on the website openinsider.com, and I type in the ticker symbol up here. So the ticker symbol is CVLG. Yeah, no, not that. No, not CG. Okay. And, since, what is this? August 1st, we've had, nothing but sales, okay? And these little 1% changes, 1%, 5%, 2%, those don't bother me. What bothers me is whenever a director unloads 28% of their shares, an EVP unloads 57% of their shares at 33, which is what it is right now, 33.01. And then, who's this? Another director unloads 31% of their shares. So that has spooked me enough to stay away for now. But that being said, not as much stay away as I think I'm definitely leaning closer towards the lower end of that margin of safety buy price. But who knows? I might change my mind. This is not financial advice. It's just me kind of working through my own thought process and hoping that you learned something along the way. So if you did, like and subscribe. If you want to see more like this, let me know in the comments. Let me know recommendations. That's where I get a lot of the ideas. Okay, so keep on commenting and keep watching my videos. Thank you. See you next time.